Hi, I'm Robert Promisel, one of the global portfolio managers at Resolution Capital. I'm really pleased to be joined by James Gibson, who's the CEO of Big Yellow Group. Big Yellow is one of the largest owners and operators of self-storage assets in the UK. Arguably, it has the strongest brand that has grown and extended market awareness of self-storage in that market overall. Big Yellow was founded in 1998, and so next year marks its 25th anniversary. Congratulations, Jim. It's grown from one asset just outside of London in Richmond to over 100 assets spread nationwide, although with a large concentration still in the London market. Shares are listed in London, just under a £3 billion market capitalization. You had a good 2021, almost a 60% total return, and the shares are trading strongly. So before, as we start, maybe you could just talk a little bit about self-storage as an asset class and what some of the key points that differentiate and set that apart.
Yeah, firstly, thanks, Robert. Thanks for having me on. Yes, I mean it's an asset class, as I'm sure many of the Australasian investors will know, because they know it, that thrives on change. It thrives on local economic change and activity. It is a class that proved to be relatively resilient during the downturn, not just in the UK, but in Europe, in the United States, etc. And part of that is the reason I've just given. And a lot of the structural trends that have been going on for many years around urbanization, around densification of living, around the conversion of ex-industrial and ex-factory land in urban areas to mixed-use schemes, around household formation, around people getting together, people separating, all of these kind of typical drivers that you find in big urban cities were pre-existed COVID, pre-existed the pandemic, and have continued, and to some extent have had some acceleration. And what we're seeing from our recent surveys is that awareness of the product, which has been growing steadily but very slowly over the last, thanks for pointing out, Robert, but I think 24 years or whatever it's been since we started in this game, has had a little bit of a step up as a result of the pandemic, where individuals and businesses with time on their hands looked at both their lives, how they wanted to live, where they wanted to live, and we provided a solution for them. In particular, the trends around working from home, how do I create space at home? The trends around business startups. Businesses occupy about 36% of our space. If you're starting a business today with all the technology and digital tools available, you're not going to necessarily want to have a high street shop and all those fixed costs. What you will do if you need what you will need if you're an import exporter, if you want to do online retailing or provide services in urban conurbations, is you're going to need space of some sort. And our business customers are typically micro enterprises in relatively small businesses. So I think a lot of these factors pre-existed. The pandemic has, if you like, accelerated some of them. And I think those underlying structural trends are going to remain beyond, hopefully, the end of the pandemic at some point this year.
Right. So there's been a step change in your customer demand, it sounds like. E-commerce companies now are using storage in a way that you hadn't seen.
E-commerce, field teams, exactly. E-commerce, field teams. I mean, we always had them. I mean, what we've seen is that our total space occupied by businesses is around 36% of our occupied space. We have a portfolio of 6.1 million square feet, and we have another 1.1 million in the development pipeline. And of our occupied space, the business is occupied, currently at around 87%. And of our occupied space, businesses are in 36%. And that hasn't changed materially over the last 5-6 years. What has changed is the constituent makeup of that has changed. And we are definitely seeing more online businesses in our business, as opposed to things like document storage and some of the more traditional uses.
Right. One of the things that's so noticeable about your company is just the real brand awareness. Even though you may not necessarily be the largest portfolio in the UK, you certainly, in many ways, are the industry leader. Can you talk about operational scale and how you've been able to increase the efficiency of interacting with customers and really the shift to online technology?
Sure. Well, in terms of the size of our platform in the UK, it is the largest, and it's the largest by revenue. We have 106 stores at the moment, but their average size is around 63,000 square feet. So in terms of the total scale of the platform, it is the largest, but not necessarily by number of stores. And in terms of revenue, it is the largest. Well, brand and delivering a market-leading operational platform was one of our key strategic objectives right from the beginning. So our portfolio, you find the assets, they're large structures, they're on main roads, they're highly visible. It is a very recognizable brand with very high recall. And obviously in the old days, we used in the spring, summer months, because it's a seasonal business, that's where you get most of your demand. We used television, we used radio, we used our buildings, we used direct advertising on yellow pages and the like. And then we had a proportion, I think about 25% in the early days, were just walking off the street, not having, trying to find out what we needed, literally turn up with their stuff. That's pretty minimal. Obviously, we get 0 from directories, and we get about 95% of our demand now through our online, mobile, and desktop channels. And that has very much been the focus over the last decade since the onset and of smartphones and the like. And now on our business, we've done very significant development. You can actually find a store, find a unit, compare prices between stores, reserve a unit, check in online, and when you get to the store, a bit like renting a car, pretty well everything's done, other than you just need to want to check where maybe you want to make sure you're happy with where the unit is. You maybe want to make sure that you're happy with the size, and then you move in. So we've made our operating platform a lot more efficient, whilst at the same time leveraging off the brand has meant that our cost of acquisition of prospects and customers is one of the lowest or if not the lowest, I think, in the UK and Europe, because of our high volume. So that's where the brand is extremely important. And that's where having a name that people recognize when they're searching online, particularly on their mobile. Mobile's about 65% now of our demand comes through smartphones. So having a brand and also having a digital execution that's easy to use, that gives the modern day customer what they want, is also very critical. And that is very significant investment. About half our prospects come through PPC, which is paid channels, and about half come through the SEO and other partnerships and the like. And obviously that cost of acquisition is cheaper, but the blend is still extremely competitive, given what on average a customer pays us when they stay, for 8 or 9 months.
Right. Great. So one of the things that we've observed over time has been this steady improvement in the occupancy in your portfolio. I remember coming out of the GFC, occupancy was far lower than it is today. It touched into the low 90s in 2021. It's been a really interesting journey for you guys as occupancy has improved. Where do you see this headed going forward? You're a couple, still a bit below where occupancy levels are in the US. Is that something that you see continuing to improve?
Well, I mean, if you go back and look back to 2007-8, and I do remember talking to you, Robert,
Yes.
during the GFC and having a discussion about whether or not we should build out our London portfolio into a recession. The view we came to, Nick and I came to, was that
Absolutely.
Given that you had deflation on construction costs, deflation on borrowing costs, highly competitive, we use mid-sized contractors and we do our internal fit out. We took the view that we must be able to get these things to 65% occupied. They break even in London at 25 to 30% occupied. So let's get them built and let's see how we go. Now, if you go back to 2007 and look at today's capacity, we were effectively at around 42% occupied. And now, as you say, so in other words, what we've done is over that duration, we've broadly doubled revenue, we've trebled earnings, and we've added all the capacity we've actually filled up. So part of the reason the percentage occupancy always seemed low to you was because we were adding capacity. By way of example, in 2007-8, we had 40 odd centers open. I just said we now have 106. So that's quite a lot of capacity being added. And every time you open a store, you've got 0 customers, and it's a speculative investment, and you have to go from there. And these assets, as you know, take longer to fill up than, by way of example, a hotel. But then they have less volatility than the hotel, as we've demonstrated both through the Great Recession and indeed this pandemic.
Yeah, we'll take steady, stable growth any day of the week.
So to answer the question, sorry, I didn't answer the question. I'll come back to it. Apologies, Robert.
Yeah.
I believe that we peaked, as you say, in the early 90s in the summer. So our average occupancy this year, because we're in our 4th quarter here, may end up at, say, let's call it 89% or something of that nature. Our aim each year is to try and move that forward. And I'm not going to give a time scale on it, but given supply, and we should talk about supply, given the restrictions on supply around our model, which is London, commuter towns, big cities, we believe there's no reason why we can't get our average occupancy across a 12-month period into the early 90s and perhaps to the level seen in the United States of around 93%, 94% over time. What we're doing at the moment, now that we've filled the stores up and are opening 2 or 3 a year, we're actually opening 4 stores in 22, 23, is focusing on yield management and growing our rents, because clearly we've got less vacancy to sell, and our yield management systems are, and you can see that in the numbers we just announced in January.
Right. So the shift is really turning, as you're having incremental occupancy growth, the shift is really turning to having some pricing power, which must be very pleasing.
Yeah, and one of the factors about storage is that the operating costs on a center of, say, 65,000 square feet are relatively fixed. Clearly, there are some variable costs. And broadly, operating costs are split between salaries, between property rates, i.e. occupational costs, because we own our assets freehold. That's another factor. This is largely, we own sort of 98, 99% freehold. And then the rest is your marketing and energy and the like. So facilities, etc. So and our operating margins at the moment are around 70%. And so as you grow revenue and grow occupancy and drive rent growth, you get quite a high drop through once these assets get into a net contribution position. And that's how we've managed to achieve the doubling of revenue over the last decade and trebling of earnings, or slightly over a decade from 2008, and trebling of earnings. It's a function of what I was talking about there. It's a function of that operational efficiency. I mean, clearly you've got to be able to fill the stores, and that's why putting them in urban conurbations and heavily focused, our portfolio of 75% London and its commuter towns, which is where the dynamism of the UK economy is, by putting them in these higher demand areas where the barriers to competition around supply are also highest, it gives us the confidence that we will be able to get on average into the early 90s. We will be able to achieve rate growth, because the thing that we most worry about is supply as opposed to the ebbs and flows of demand.
Right. And the supply picture, the barriers are much higher in the UK than what we've observed in the US or even in Australia. You have 13, 14 property pipeline and land sites available, add another just over 1 million square feet. Maybe you just talk to us about the time frame it takes you from conception of a project to completion, and then the time it takes to stabilize the operations.
Yeah. I think if you want to compare, a business like Big Yellow in terms of our supply constraints with either the US market or Australasia, you need to look at their big urban markets. So trying to execute in the center of the, larger US cities is not easy.
Right.
In the more rural areas, sure, and in the smaller towns and city, and it's similar here. If you want to execute in London, all the low-hanging fruit have largely gone. If you're trying to execute, you can't really get into zone 1 unless you're in a basement. But if you're trying to do zone 2, zone 3, typically you're looking at mixed-use schemes. You're competing with industrial, urban logistics, mixed-use residential. So the competition for land for these 1 and 3 acre sites is high. If you can then land one on which you have a reasonable, you've done your due diligence, you have to buy it unconditionally, otherwise you're not in the game. You then have to have a real confidence that you're going to get planning. And of the 13, 14 you mentioned, 9 have got planning, or 8 have got planning. I think it's 9. So you have to have the skill set to get the planning. The planning can take, at the shortest, 18 months, which was Bracknell, to potentially, in the case of King's Cross, a very complicated scheme. It took us 4 years. I mean, that's an exception. So let's take average 2 years, 2.5 years. Then you've got to build the thing, which can be a year to 18 months, depending on when you're putting a basement in. So from acquisition to, to opening could be 3 years, 4 years, and then you've got to fill it, which is another 2 to 3 years. So, each of these things is like a 7-year business plan, if you like. Right. They break even at about 25% occupancy. Typically, you'll get there in 6 to 9 months in these urban areas, and then you just keep filling and try and do it as fast as you. I mean, we've opened some stores recently in London, in Uxbridge, and they're filling very quickly. It's opened into an area of West London where no one's opened an asset for over a decade. So everything around it is full, and you're opening into that environment with growing awareness. So
sure,
that's the nature of what is happening. There are assets opening in London, but we estimate the rate of opening is around, and we're opening some of them, is around 2.75%, 2.5% of the total capacity in London at the moment, which is around 12 million square feet. So, and that applies to the commuter towns, and that applies to the big cities. So barriers to competition are critical, in our view, in any operational cash flow real estate business.
Of course. The other interesting thing about self-storage, one of the many interesting things, I think, is the shorter lease nature of your tenancy, and what that means as we're entering this interesting period of higher inflation. Am I correct in believing that self-storage is well placed for basically operating in an inflationary environment by passing along some of the higher costs through rents that get reset more frequently?
Well, I mean, we have traded through a period of high inflation, which I think was around 2010-11, when the oil price spiked and inflation in the UK went up to around 6%. And we moved our pricing and quite aggressively using the inflation as cover. And, it all went through. But you're absolutely right. If someone moves into your store, typically 70-75%, in our case, haven't used self-storage before. They don't really, it's not a particularly commoditized product in that sense. They don't really know how much, they don't even know how long they're likely to stay. They think they're going to stay for a period of time. Invariably, they tend to stay a bit longer. If they stay less than 6 months with us, they don't get an increase. If they stay more, they'll get one increase at 6 months and then annually thereafter. The leases they come in on are 7-day minimum stay, 7-day notice, but it's a 28-day billing cycle. You stay as long as you want. And what we have done with a more inflationary backdrop is we have increased our asking prices by 4% on the 1st of October 21 and another 2% yesterday on the 2 days ago on the 1st of February. So in total, around 6%, because that is our estimate, and indeed the Bank of England has confirmed it, of what inflation over the 12 months, the next 12 months is likely to be. We've also noticed that as UK PLC self-storage, i.e. our main competition, because we look at them all and we track their pricing and the like, they're all at higher occupancy, and they're all moving their rates up as well and reducing things like some of the more aggressive opening offers. So there's a bit more discipline coming to the market. And again, for the same reason that they're needing to look at maintaining their operating margins and they're at higher levels of occupancy. Now, if you were in a market where supply wasn't constrained and there was a lot of vacancy sitting around, you wouldn't have that impact. So we've all been through the Great Recession. We understand how it behaves in both a recessionary cycle, in a pandemic, and now we're getting into a more inflationary period. Now, we don't know the answer to this, but if the experts are right, and some of this inflationary COVID-related or pandemic-related impact will fall away towards the end of the next 12 months, then maybe that'll moderate. But in the meantime, we've done that, but we're also increasing our asking prices to existing customers, with the lowest number being 6% and the highest for those who are paying significantly below the current market level, if you like. In other words, what others are paying, and indeed what we're advertising online, they may be getting 15 and 20% increases. Right. So we started that in January. So the aim is to deliver, having delivered in the our last update, we were showing that we were doing, I think, 9% average rental growth, something of that nature in the last quarter. We will look to deliver quite strong average rental growth in the 12 months ahead to take us through this inflationary period. And we're not seeing, and we rarely see, significant pushback. If a business comes with some pushback, we'll say, look, you have a look online. You're still paying below what we're asking new customers to pay. And, that's the, if it's a 6% increase, I mean, all you have to do is read the papers to realize that that's where inflation is. And hence it makes sense that we're using that, that we're increasing our end prices because our costs are going up. So it is one of these products. Now, some would look at self-storage and go, you've got, in our case, 80,000 customers today. They can move out with 7 days notice, but that's just never going to happen, right, statistically. And this product's been going for decades and has been through, in the US in particular, very difficult conditions. And there's always someone where change is causing them to require the product, and others where change is causing them to no longer require the product. And it's a dynamic of the two. And on average, it's proved to be relatively resilient.
That's great, Jim. Thank you. Let's leave it there. Jim Gibson, CEO of Big Yellow Group, thank you very much. Thank you for sharing your time and for always taking the long view about how you approach and operate your business. Many thanks.